Picture this scenario, because I guarantee some version of this has happened to you or someone you know. You finally do the responsible thing after graduating. Every month, you move a little bit into savings. $50 here, $100 there. You feel good about it, responsible, on track. But then one day you open your banking app and notice something strange. You've got $2,000 sitting there, and it's earning something like 0.5% interest, which means after an entire year, you've made about $10. Meanwhile, everyone your age seems to be talking about investing, index funds, Roth IRAs, compound growth, and you start wondering, wait, am I doing this wrong? Because saving money is good, but saving alone almost never builds real wealth. And this is exactly where most recent graduates get stuck. They know saving matters, but they have no idea how to actually move from saving into investing. So in this video, we're breaking down the exact step-by-step path to turn your savings into real investments, without feeling overwhelmed and without risking the safety net you've worked to build. I'm TJ, and I make videos about money for people just starting out. Recent grads, people in their first real jobs, with their first real paychecks. If you've got money sitting in savings but you're not sure how to actually start investing it, this video is built for exactly that situation. Let's start with something that might sound a little uncomfortable. Saving money alone will almost never make you wealthy. Saving is important, but it is not the final destination. It's just the first stage. Here's the actual difference. Savings protect your money. Investments grow your money. Those are two completely different jobs, and confusing the two is where most people get stuck for years. Let's look at the math. Imagine you save $2,000 in a typical savings account earning 1% interest. After 1 year, you'd have $2,020. Not bad, but not exactly life-changing. Now, if that same $2,000 earned 10% annually in an investment, after 1 year, you'd have $2,200. That initial gap might not seem huge, but here's the critical part most recent graduates miss. The real difference explodes over time, through compounding. After 20 years, that same $2,000 in savings at 1% grows to about $2,400. Invested at 10%, that same $2,000 grows to roughly $13,500. Same starting amount, completely different outcome. And here's the part that actually matters most for someone your age. The biggest wealth gap isn't between people who save and people who spend. It's between people who save and people who invest. Most people never make that transition. And the reason isn't math, it's psychology. Saving feels safe. Investing feels risky. When your money sits in a savings account, you can see it. It doesn't move. It doesn't drop 5% on a random Tuesday afternoon. But investments move, sometimes up, sometimes down. And that emotional discomfort is exactly what keeps recent graduates stuck in savings mode for years longer than they need to be. If you're thinking, okay, but TJ, I don't want to lose the little bit I've managed to save, that's completely fair. And that's exactly why this transition should happen in stages, not all at once. With step 1, build a real emergency fund first. Before you invest a single dollar, you need 3 to 6 months of basic living expenses saved in cash. This money stays in savings. It is not for investing. It is not for opportunities. It is specifically for the unexpected. A lost job, a medical bill, a car repair you didn't see coming. Here's what most recent graduates don't realize. The number one reason people panic sell their investments is because they needed that money too soon, for something urgent, and investments were the only place they had cash sitting. An emergency fund protects your future investments from your own life happening around them. For someone just starting out, this number might feel intimidating. If your basic monthly expenses are $1,200, saving 3 to 6 months of that is $3,600 to $7,200. That can feel far away when you're also paying off a student loan and figuring out your first apartment. That's okay. This step can take time. It's supposed to. Step 2. Separate saving from investing, mentally. This is bigger than it sounds. Think of your money in 2 separate buckets. Bucket 1 is safety money. Bucket 2 is growth money. Safety money doesn't move. It sits in your emergency fund, untouched, boring on purpose. Growth money is allowed to fluctuate because its entire job is to grow over time, not to stay perfectly still. This mental separation is what actually reduces the anxiety around investing. Once you know your safety net is handled separately, watching your investment account go up and down stops feeling like a threat to your survival. Step 3. Start investing small, immediately. A lot of recent graduates assume investing requires thousands of dollars sitting around first. It doesn't. Many investing platforms let you start with $50 or $100. The goal at this stage isn't massive returns. The goal is building the habit, because the habit matters more than the timing. If you wait until you feel like you have enough to start, you'll likely wait years longer than necessary and lose all of that time to compounding you could have already had working in your favor. Step 4. Focus on simple investments first. Here's where a lot of beginners make an expensive mistake. They jump straight into complicated strategies. Day trading, options, chasing whatever coin or stock is trending that week. But the simplest investments often outperform the complicated ones, especially for someone just starting out. Index funds are the clearest example. These funds track the overall stock market. Instead of trying to guess which individual company will win, you're automatically invested across hundreds of companies at once. That means built-in diversification, lower risk than picking individual stocks, and steady long-term growth. It's simple, and it consistently works, which is exactly why some of the most respected long-term investors keep recommending low-cost index funds to beginners specifically. Step 5. Make it consistent, not occasional. The most powerful investing strategy isn't clever. It's boring. It's called consistent investing. Here's a real example. Imagine you invest $150 a month, starting right after graduation. If the market averages 8% a year, after 25 years you'd have roughly $140,000. But here's the part that surprises most people. You would have only personally contributed $45,000 of that. The remaining $95,000 comes purely from investment growth. That's compounding, working entirely in your favor for money you already decided to set aside every single month. Psychology still matters here, even once you understand the math. Investing feels uncomfortable at first. Markets go down sometimes. News headlines get dramatic. People panic. This is exactly where discipline separates long-term investors from people gambling. Think of it like this. Saving money is like storing seeds in a jar. You're protecting them, but nothing is growing. Investing is like planting those same seeds in soil. At first, it looks messy. You don't see results right away. But over time, something actually grows, and eventually it becomes far bigger than the original seeds ever were sitting in that jar. You might be wondering, Andrei, what if I start investing and the market crashes right after? That's a fair question, and here's the crucial answer. Market crashes are normal. They've happened repeatedly and will continue to. But here's the part almost nobody explains to recent graduates. Long-term investors actually benefit from downturns, especially early in their investing timeline. When markets drop and you keep contributing that same monthly amount, your money buys more shares at a lower price. This often leads to significantly stronger returns once markets inevitably recover, which they historically always have. This is exactly why experienced investors stay calm during volatility. They are thinking in decades, not in days. And if you're in your early 20s, decades is precisely the timeline you have on your side. Let's put the full path together. First, build a 3 to 6 month emergency fund in cash. Second, mentally separate your safety money from your growth money. Third, start investing small amounts immediately, even before you feel ready. Fourth, focus on simple, diversified investments like index funds instead of complicated strategies. Fifth, make your investing consistent every single month, and let compounding do the heavy lifting over time. Here's the truth most people eventually learn, usually later than they wish they had. Saving money gives you stability. Investing gives you freedom. The earlier you combine both, the more powerful your financial future actually becomes. And starting right after graduation, while you have decades ahead of you, is about as early as that advantage gets. If this helped you understand the actual path from saving to investing, hit subscribe. And I'm curious, are you still in the saving stage right now, or have you already started investing? Let me know in the comments, because the moment you make that shift from saving to investing, that's the moment your money actually starts working for you instead of just sitting there. Thanks for watching, and I'll see you in the next one.